Welcome to another podcast by the Central Bank of Kuwait. Our podcasts aim to discuss key banking issues that impact the lives of both individuals and the society. I am your host, Shifa Al-Awadi, entrepreneur at the Central Bank of Kuwait. The main roles of the Central Bank of Kuwait include the issuance of the national currency on behalf of the state, sustaining monetary and financial stability in the country by maintaining the stability of the Kuwaiti dinar and securing its free convertibility into foreign currencies, as well as directing credit policies with the aim to contribute to social and economic progress, in addition to enhancing the national income. Other key roles of the central bank include supervising the state's banking system, as well as assuming the position of the government's bank and its main financial advisor. Today's episode will address the Central Bank of Kuwait's role in strengthening financial stability and how the central banks play a key role in maintaining sound and resilient financial systems. Our guest today is Wadha Al-Hneidi, Senior Financial Analyst, who will be giving us a glimpse into the importance and the resources used to reinforce financial stability in the country. Welcome, Wadha.
Thank you, Shifa, for having me on this podcast, and it's a pleasure to welcome our listeners as well.
To begin, Wadha, would you explain to our listeners what is meant by financial stability?
Yes, of course. Financial stability refers to the financial system's ability to perform its role continuously and without interruptions, even under stressful circumstances. Therefore, it relates to the ability of financial institutions, most notably banks, to sustain core businesses and operations efficiently and easily, without disruptions to the services offered to both individuals and institutions. With that said, the availability of important financial services like extending financing, providing cash withdrawal services, and providing transactions to other parties within or beyond the state of Kuwait are all indicators of financial stability.
Thank you for the explanation. It seems most people take the availability of financial services for granted, but its availability is important for individuals, institutions, and the state as a whole, especially during a crisis or under stressful conditions, as you put it. You mentioned the financial system. Could you please tell us more about the components of the system?
Well, to begin with, the financial system in any state is the system through which funds are exchanged among savers, borrowers, and investors, and consists of key components that contribute to the state's economy. The first component is financial institutions, which include banks, exchange companies, and finance and investment companies. The second component is financial markets, such as Kuwait's Borsa, and finally the last component is infrastructure, which refers to the systems and data that facilitate financial system transactions. It is important to stress that banks are considered the main component of the local financial system in the state of Kuwait, which is why most of my answers will focus on banks and their importance, as well as the role of the central bank in safeguarding financial stability.
So, it's safe to say that the central banks actually are the institutions that safeguard a state's financial stability, right?
Yes, that's correct.
Would you explain the different ways in which central banks maintain that stability?
To put it simply, central banks maintain financial stability through four main steps. The first step is the vigilant and continuous monitoring of economic and financial indicators to detect any developments or threats. The second step is analyzing the impact of the detected changes and how they can affect local financial institutions. The third step is to detect the sector's strengths and weaknesses, as well as indicating any possible challenges that the sector might face. Lastly, and the most important step, is to take a proactive stance through the deployment of regulatory tools, such as macroprudential instruments, to alleviate systemic risk.
You mentioned monitoring economic and financial indicators. If you would please elaborate and give us some examples.
Yes, of course. There are many indicators that are monitored routinely, which provide a clearer picture of the soundness of the financial system. These indicators can be divided into economic and financial indicators and indicators for assessing the banking sector's performance. Starting with economic and financial indicators, there are global indicators that we monitor, such as the S&P 500, which is an indicator of equity market performance. This is, of course, in addition to local indicators, such as oil prices and real estate prices. As for indicators to gauge the performance of the banking sector, which are also monitored routinely, we have the capital adequacy ratio, which allows us to measure a bank's solvency. There is also the return on average assets and the net profit margin, both of which we refer to when measuring profitability. As for the bank's liquidity, the liquidity coverage ratio and the net stable funding ratio are among the key indicators.
And how do we benefit from monitoring these indicators?
As we have mentioned before, these indicators help us spot the weaknesses and strengths of banks individually or the financial system as a whole, which could negatively impact the sector. By identifying weaknesses early, a central bank is able to decide on the appropriate and effective means of intervention that could be utilized to help banks overcome any crisis they may come across, before the ramifications affect the bank's performances and their resilience.
This is very interesting. You mentioned detecting points of weakness within the sector. How do we pinpoint those weaknesses?
Detecting or pinpointing points of weakness or vulnerabilities is very significant, and it's important that this is done continuously with a proactive approach. Vulnerabilities are mainly detected by performing stress testing. The Central Bank of Kuwait applies stress tests based on several scenarios with a range of severities. It is important to also note that stress testing does not foresee the future, but is based on hypothetical scenarios of a certain crisis, which helps quantify the impact on a given bank or the banking sector overall.
Once vulnerabilities are revealed, you mentioned instruments for intervention that could minimize systemic risk. Would you please give us an example of that?
Yes, correct. Once a vulnerability is detected, we move on to determining the intervention instrument needed to counter that vulnerability, which can either be a financial or non-financial instrument. Examples of financial instruments include requesting an increase in a bank's capital, adjusting liquidity ratios, and limiting exposure to certain sectors. As for non-financial instruments, they include a number of soft interventions, such as increasing individual bank supervision and communication for vulnerable institutions.
Now that you've given us examples of instruments used to counter stresses, would you explain to us how we can tell if a financial system is actually stable or not?
Basically, as I mentioned in the beginning, as long as financial institutions are continuously operating without any disruption to businesses, then we can conclude that the financial system is stable. To be more specific, since banks are the key component of the financial system in Kuwait, we can easily say that as long as banks are accepting deposits from individuals and extending financing to individuals and institutions without interruption, then this means the financial system is stable. But there's another question that I wish you would ask me that will shed more light on the issue.
What's that question?
The question is, what are the indicators of a strong and resilient banking sector? And I'll answer that with a simple example. If we were to construct a bridge across a certain street, pillars and bases are raised, and they must be strong enough to withstand the capacity and load that would be crossing over the bridge, right?
Correct.
Likewise, for banks to perform their role as financial agents or mediators on a continuous basis and without disruption, we need to guarantee what we call the 4 pillars of stability, which are mainly solvency as the first pillar, which means that a bank has sufficient capital to withstand potential losses. The second pillar is liquidity, which means that the bank has adequate liquidity to cover any deposit withdrawals that could take place or any short-term liquidity needs. The third pillar is asset quality, which means that a bank's investments and loans are extended to entities that are likely to pay back. And lastly, the fourth pillar is profitability, and by that we mean that banks make enough profit to grow organically, or in other words, making profits that are sustainable and stemming from core operations.
Excellent. Could you please tell us more about the status of these indicators when it comes to Kuwaiti banks?
Thankfully, the Kuwaiti banking sector is strong and resilient, based on the indicators we mentioned previously, specifically solvency, liquidity, asset quality, and profitability. Firstly, with regards to solvency, the capital adequacy ratio stood at a high 19.9% in the last quarter of 2023, where the minimum requirement for banks is 13%. Secondly, banks are in possession of ample liquidity, which was reflected in the liquidity coverage ratio and the net stable funding ratio, with each reaching 169.3% and 113.3% respectively by year-end, where the minimum requirement is only 100%. And thirdly, the bank's assets are of high quality, as reflected in the low percentage of non-performing loans, which settled at a historical low of 1.4%. Lastly, banks enjoyed high profitability, attested to by a profit growth rate of above 20% in each of the past 2 years.
Before we conclude this episode, you mentioned that stress tests also demonstrate the resilience of the banking sector. Would you please explain what stress testing is and what is its benefit?
Sure. To explain how stress testing works in a simple and clear way, I want to go back to the example of the bridge that we talked about earlier, where we said that there must be pillars and bases to support the heavy load so the bridge can function reliably. Logically, the sufficiency of the pillars must be checked against unusual scenarios, such as heavy rain, strong wind, or a massive load. Would the bridge withstand such unexpected stress? If the conclusion is that it might not withstand such pressure, then increased reinforcements are needed. It's the same when it comes to banks and stress testing. The idea is to subject banks to similar unexpected shocks by applying hypothetical, hostile scenarios to the bank's financial positions. Once the scenario narratives are complete, we identify the possible shocks that a bank could face in that specific scenario, and how those shocks impact the bank's financial position and integrity, which is similar to the pillars we mentioned before. After that, we can determine the various instruments that we can utilize to support the banks, assess the situation, and address any subsequent losses.
Thank you for this explanation. Is there anything else you would like to add before we conclude?
I tried to simplify the concept of financial stability and the means of maintaining it as best as I could. And if anyone is interested in knowing more about the topic, I recommend reading the Financial Stability Report that the Central Bank of Kuwait publishes annually, which is available on the bank's website. They can also listen to the podcast published on the 30th of December of 2023, which talks about the Financial Stability Report in more detail.
Thank you, Wadha, again, and we appreciate you coming on today.
Thank you for having me.